If you're in the field of finance, business, data, and are navigating spreadsheets day in and day out, trying to get the data right, trying to set those rows, make sure you've got the right formulas, meet deadlines, then this podcast is very much for you. I'm talking to Ajinkya Tanpure on the 55th episode of Karishma Connect, a VC turned entrepreneur in the UAE who has launched his own platform called CrossVal. What spreadsheets don't do in 4 weeks, CrossVal does in 4 minutes. It's extremely interesting to know his journey. There's a lot to learn about valuation, startups, venture capitalism, what's evolving in the market, how can one keep up with it, what's in it for budding entrepreneurs, and what they need to keep in mind. So go check out this enlightening conversation. And until the next one, stay tuned because this is Karishma Connect and this is me, Karishma. So thank you so much, Ajinkya, for joining me on today's episode of Karishma Connect. I look forward to sharing your story with the audience who I think would enjoy it because there are a lot of insights that I believe you would be able to share. And it's a pleasure to have you.
Yeah, it's a pleasure to be here. Thanks, Karishma.
Most welcome. So, to begin with, the first question that I start off, and I think because every person tells their journey best by themselves. So, just dig right in. Tell me your journey. How are you where you are? What makes it special to be? And how did you get started?
I think the journey began when I was very young. I just grew up in a house where entrepreneurship was something that was encouraged from a young age. And then going into university, I studied engineering, where I realized I have a knack for problem solving. And from there, I went into venture capital. I was good with numbers and I understood technology, and I didn't really fancy an engineering job. So um, it just so happened to be a perfect fit in VC. Spent a few years there, and then the natural trajectory is you stick around in VC or you move up to private equity, which is not a lot of technology investments. You invest in like later stage businesses. Sometimes it's tech, but later stage. And one of the things that remained constant was spending hours of my day on spreadsheets, maybe 12, 14 hours just on Excel, right? And then, of course, the engineer in me realized there has to be a simpler way to do this. And that turned into sort of what I'm doing now, which is CrossVal. So I founded this company that eliminates the need for using spreadsheets. So you don't have to spend hours. So people like me don't have to spend hours building these financial models.
Mm.
And yeah, that's essentially how the journey sort of transpired. And yeah, it's been a fun one.
And I'm going to ask you, I'm going to get into Crosswell later, but I would like to ask you what have been your learnings during that span when you were transitioning from, say, from being an engineer into becoming a VC and then finally finding Crosswell? What have been some of your key lessons that people can kind of take away from?
Yeah, I think the biggest one is patience. I was a very ambitious kid. I always wanted to know what I was doing and know where I was heading, and like always couldn't wait for the next thing and how
Mm.
this would turn into success, and that would turn into success, and this would happen, as we all are, right? And I think the biggest one would be patience to just uh, keep working hard, keep sort of doing what you're doing day in day out, and then the fruits will come. So the biggest takeaway would be that just yeah, wait it out. Just but don't wait it out while doing nothing. Make sure you're putting in the work that you need to put in. But when you look back on the journey, the dots line up. You look back and you think, oh,
Yeah.
that's exactly the path I should have taken. But when you're looking ahead, you can't see all of those paths connect. Um, yeah, that's I think just having patience is the biggest key.
And with that ambition and with operating in such a high risk environment, it gets to you, right? There's a lot that you deal with at a personal note. How do you deal with that? What's been your mantra to kind of dealing with risk?
Uh, s- so there's the risk that comes with it, and then there's the stress. With the risk, I think you just get normalized to it. Now, like if you speak to a founder, or when I speak with my founder friends, risk is not really a part of the equation for them. They or we know what we want, and we're willing to sort of risk things for it, but it just normalizes over time. it's only risky when you go from like a really comfortable job or a really comfortable life into being an entrepreneur and not knowing sort of if there's financial security or not. That's where the risk is. But once you take that jump, it normalizes. You get used to, being unsure about what the future looks like. You get used to being unsure about sort of money, things of this sort, right? And then over time it solves itself, but you just get so used to it that it doesn't even feel like risk anymore. But then at the same time, of course, that's an emotional answer. But realistically, I think you should diversify, and I did sort of early in my job. I knew that I'd take this leap someday, so I was putting money aside, having backups. I also, of course, um, live with my family, so that sort of undoes a lot of the risk, which is really good. But um, yeah, so I think speaking realistically, there are things you can do to diversify the risk
Hmm.
of entrepreneurship. And in today's day and age, that risk, that barrier has come so low,
Hmm.
where with remote work and things, you could be running a business in your off hours and no one would even know, right? It's
Yeah,
become so easy to
absolutely.
make money on the internet. Yeah, so I think just making sure you use all of those opportunities will heavily de-risk you.
And then if you're a VC turned entrepreneur, does one lend into another basically? How does that experience help?
I think it doesn't lend into it as much
Yeah.
if you are someone who's naturally a risk taker.
Hmm.
I wasn't. I was a very conservative person. But being in a VC, being in that environment, constantly interacting with founders, interacting with entrepreneurs, that changes sort of how you think.
Hmm.
And that whole law of averages comes into play, right? You're the average of the five people you spend most of your time with.
Hmm.
And then if you're in a VC, you get sort of really easy access to entrepreneurs. You can understand how they think, how they operate. Um, and yeah, I think that was the biggest takeaway. Other than that, of course, you understand how VCs think and how they invest and how they make decisions. All of that is great. But I think the biggest takeaway that'll stick with me for the rest of my life is the relationships I built with founders back then, and the learnings I had from that about taking risks, having passion towards the products you're building. Those lessons are really good, because as a VC, you're not taking any of the as an employee at a VC, you're not taking any of the risk that a founder is taking. But you're
Yeah.
getting all the access into these companies and into these early stage ventures. And you can sort of observe like you're at a stadium and see what works, what doesn't, what kind of founder ends up being successful, what kind of founder doesn't.
Hmm.
Um, yeah, so I think that would be the biggest takeaway. It really teaches you how to think big and how to take risks and how to operate in an efficient manner. If that doesn't come to you naturally, there's a lot of founders who are naturally like that and they don't need any sort of uh, founders 101 lessons like I did. But yeah, I think that's the biggest takeaway.
And in the past, I've interviewed somebody called Prantik Majumdar, who's also into venture capitalism and angel investing. And I was just talking to him and discussing how the times have changed when, in age old times, say from the time of your father or my father or beyond that, it was all about the barter system, or it was all about money lending in the traditional sense. And today we have venture capitalism and angel investing coming into the market. And he told me how it was different. I'd like to ask you the same question. How do you think the industry has evolved to embrace newer forms of financial modeling and management? And what do you think is in store coming up?
I think the world has evolved into to a point where uh, the finance used to be sort of the catalyst, or the fundamental need for an entrepreneur to set up a business, right? That's why you'd see businesses coming up from the better or the higher chunks of society who have generational wealth.
Mm,
But now that's gone. Now it's the money is a catalyst, but it's not a fundamental need to start something off. You can start an influencer campaign or start becoming an influencer for free. You need like a phone and a camera maybe. So that's gone, but money is still a catalyst. So if you still want to scale and make turn into a huge company, you still need cash, and that's where venture capital comes in. So I think that, again, coming back to how there's lower barriers to entrepreneurship now, I think money is no longer a barrier to building a business, or at least a lifestyle business. But of course, a super scaled tech company will still need loads of cash. But yeah, one of the things that's changed from sort of the times of our fathers is money is no longer a barrier. It's still an enabler. It's no longer a barrier. And in the future, I think the trend will continue, where humans are going to figure out simpler and more efficient ways to, pursue their dreams, um, and money will be a good outcome of it. I mean, in India, we're seeing examples of highly scaled businesses which never raise a dollar from VCs or angels, which is really cool to see, and it's really difficult to do as well. And us internally, we have a big focus on profitability and ensuring that we're not at a point where we're burning capital without worrying about profitability and sustainability. So things are changing. Let's say in the last decade, or in the 2000s, it was all about growth. You could spend whatever amount of money, you could get capital and keep growing. But now it's turning into a sustainability game. Who can survive the longest? One of the things I always think of is, if you're a startup or an early stage venture, your top priority is to survive, at least for the first 2 to 3 years, because if you can survive for that long, most of your competitors or most of the people who start will either give up or fail. And if you're able to sustainably survive until then, your chances of success go up exponentially. Um, so yeah, I think founders will get a lot more lean, a lot more efficient with how they spend their money.
And what are your tips for, what are your 3 tips for early founders who are in that stage starting out to kind of sustain through that cycle of 3 years or 4 years, however much it takes them to emerge successful?
Yeah, I think personally, on the personal side, make sure you've got enough saved up so that you're not, stressing every night, or at not at peace. And of course, that's difficult to do sometimes, but it's if you are in a position to do it, do it. If you can't, then that's an additional risk you take, and it's a part of the process. I think every founder will tell you there has been a time in their lives where it came really close.
Yes.
Uh, it's been there for
50
me.
stories, all of them have had that moment.
It will come really close, and a lot of founders like to say that you're not going to be successful unless it comes that close, right? I think the number one biggest tip is, if you're considering entrepreneurship, or if you've already taken the job, make sure you're taking care of your responsibilities. If you can plan ahead, plan ahead. Um, Other than that, the other two would be, for when you start running your business, try and note down how you spend your money, the business money and your personal money, be it on pen or paper, be it on a computer, or be it on a spreadsheet, however you want to do it, but make sure there's a note somewhere. You can do all of the accounting and modeling later, but you can only do that if you've noted it and kept track of it somewhere. Uh, and the other benefit of keeping track of it is, where the money is being spent, and you understand, hey, if I spend $1 on marketing, it's not turning into revenue. If I spend $1 on my employees, it is turning into benefit. Or if I spend $1 on this partnership, it is turning into benefit. And that's literally your job as an early stage founder. You need to figure out what channels turn into new money, right? Because you're investing when you're running a new business, and keeping track or keeping tabs of your finances allows you to do that. And that's all it is, right? It's just a game of endless optimization. In the first year, you might optimize, you might spend on product, and that is your optimal spend. In year two, product will not be your optimal spend. It might be marketing. In year three, marketing might not be optimal spend. It might be sort of customer relationships, or your own employees. And it's just this endless game, and you have to keep track of this somehow. And if you can just, collect this data for yourself in any way possible, a big mistake founders will do, and I think it's part of the personality type, is it's in my head, right? I remember, or like I'm mentally accounting for it.
Mm.
Uh, but it's very easy to get lost in that,
Yeah.
because we're all emotional beings, right? And of course, a spend that I make on a nice dinner is easily forgotten. But a spend I made on something that was actually really useful, but it was a big spend,
Mm.
is for example, we're based in the IFC, and we in the early days we'd pay rent, and I'd be like, why am I even paying for the office? I don't use it.
Yeah.
Why do I have to go to this? But that has turned into so many relationships and so many partnerships and so many clients that there's no way I can go back and track the ROI that has come out of being based there. So things of this sort, you only realize later.
Yes.
Uh,
Since I've
and yeah, so I think just keep track in whatever manner possible. Don't do the whole mental accounting thing. We all think we can do it, but our brains are not built for numbers. Our brains are built for nature, built for human beings, built for relationships. Use your brain for that. Leave all of the other stuff on paper.
And then tell me how you, with CrossVal, help others control their financial accounting in a better way.
Yeah, so the when I was at the VC, one of the big things I realized with founders was this was a struggle, right? It would take anywhere between 2 to 3 weeks to do this whole process. Um, if you have the numbers ready, it'll take you 2 to 3 weeks. If you don't have them ready, it's even longer, or you might just not be able to do it. And then personally, when I was building models for other companies, I realized, okay, the analysis also takes a lot of time.
Mm.
So we solve two key problems. One is we simplify the financial modeling process for early stage founders. So if you're a founder who needs to, figure out how they should be spending their money, how much they might make in the future, what their valuation is, et cetera, instead of spending 3 weeks or hiring an external consultant, you can just get on CrossVal, do it in less than 5 minutes.
Mm.
So some of our models are built in 4 minutes and 10 seconds. And then that takes care of you for like the next 5 to 6 years, because it's linked with all your software, all your accounting data. It's got AI integration. So it takes care of the whole process automatically. So you never have to revisit. I mean, if you want to revisit, you can, but you never have to do manual work. You can think and strategize by freeing up your mind, and also freeing yourself up from the constant stress and anxiety of, oh, are my finances in order? Are my numbers in order? So
Mm.
that's a key aspect for founders. And then on the other side, which is more of a personal, or like my work line
Mm.
that I solved for, was we improve employee efficiency.
Mm.
So someone like me who's an analyst or an associate at VC or an investment fund spends, let's say, 10 hours of their day building these models. And through our proof of concept tests, we found that we improve employee efficiency by 80%. So now that associate or analyst is spending 2 hours building models because of CrossVal, and
Mm.
spending the other 8 hours either as time on different deals, or time to recover, or time to think and strategize and really become a valuable employee,
Mm.
so on and so forth. So those are the two problems we solve for. One is simplification, and the other is optimization.
Mm.
Um, and yeah, that's what CrossFile does.
And this is for companies. In terms of individuals, why do you think it is important to look for ways that help support the process and manage it better?
I think personal finance is way ahead of corporate finance, just because it's a bigger market, I think. So we saw innovations in personal finance come in maybe 5 years ago, right? And
Mm.
corporate finance innovations are coming in just now.
Mm.
And I think at an individual level, it's that much more important, because it's the risk is much higher, right? Like in a company, if you lose a lot of money, yeah, the company shuts down and people might lose jobs, but they can then go and get jobs somewhere else. But as an individual, it's sort of localized risk, where if an individual is not managing the money well, they're going to fall short of responsibilities, so on and so forth. And as human beings, that problem is so much easier for us to understand because it's personal, right?
Mm.
My kid's affected, my family's affected, my this is affected.
True.
Whereas when you're in a company, it's, oh, the company, something will happen and I'll go get a new job. You don't think of it at that scale.
Yeah.
So personal finances naturally are really important, and how people manage them is key. And of course, now you've got apps like Sarva and Wealth Phase and a few others that you can use to just automate that process as well. So it'll invest money for you. It'll I think I don't remember the name of the app, but there's an app where you can put in like your goals. Like I want to send my kid to college in 20 years. I want to have a house in 10 years. I want to buy a car in 3 years. And then it'll tell you how you should be saving your money, what assets you should be buying, so on and so forth. So again, like with a lot of financial products, right, corporate or personal, the real product is not the tech or the simplification or any of that. The real product is the peace of mind you get. Because when you implement, a robo advisor or something like CrossVal, the real sort of value is you're paying money to free up stress in your mind, the stress that comes from managing your finances, the anxiety that comes from avoiding looking at those messages from the bank. All of these things don't have to worry you anymore because you can just use technology to alleviate it. And I think that's the key focus companies need to maintain, where we're trying to eliminate stress and pain points for the end user.
And what do you have to advise for those who are looking for valuation for their startup?
I think just if you can do it yourself, it's a great place to be as a founder. You can, it's not it's not rocket science. If you're a founder, you can figure it out. But as a founder, your time is also that much more valuable, and you're better off spending it doubling down on your specialty. And there's a bunch of tools out there, one of which being CrossVal, which can very accurately and very seamlessly figure out what your valuations are, what your projections are, so on and so forth, without spending any of the time that you might spend on doing this process. So I think in terms of advice, that would be key. And then the second one is it's always a conversation. You can negotiate up and you can negotiate down, and an investor will always negotiate down, because imagine you're buying a car. You want the best deal that you can get. And it's the same with an investor investing in a company. They want the best deal that they can get. But if you're a founder who's very convinced and very passionate about what they're building, you should stick to the number that you're looking for, that creates the best outcome for you. And then tools like CrossVal and research, etc., will allow you to back those numbers up. Yeah. And that's really sort of the approach you should be taking, where first think of what the best outcome for your company is. And sometimes that answer is you don't need to raise money. That's not the best outcome at all times, right? Some companies don't need external funding. Yeah, I think that would be key for any founder to realize that, first of all, do I really need an investment? And second, if I need it, let me think of the best outcome of this investment and then pursue it. You can't start a company and then think of trying to raise money in the first 3 months. You need to first create value, make sure that that value creation is scalable, and then if it is scalable, at that point is where capital comes in.
That right now this is a thriving market that's kind of giving opportunities. What's been unique about your experience setting up in this region?
So I've been in Dubai about 18 or 19 years, and I've seen this place as a constant opportunity, right? It was an opportunity for my family. It is an opportunity. It remains an opportunity for me, and I think it will only grow from here on. It's I think the outlook is very optimistic, which is what I admire. And I think, again, coming back to sort of founder mindset, it's all about hope and optimism, right? At the end of the day, when you're on that sort of square one, when you've just registered your license, you have very little money in the bank, and you don't have any customers, and you have an idea, all you really have is hope and optimism. And I think Dubai thrives on optimism, which makes it a great place for business, which makes it a great place to live. Because yeah, everyone aspires to be better, aspires to be happy, aspires to do well in this country. So that's what makes it a great place for business.
I mean, we've got a happiness street, happiness editor, I don't know what not
Yeah.
here. Definitely we are on that route. My last question to you, and this is one that I ask very often because I believe it breaks down complex principles into something as simple as explaining it to a 5-year-old. So tell me, if you were to speak to a 5-year-old and talk about financial management, how would you define it? How would you explain it?
Yeah. So if I was speaking to a 5-year-old, I think I'd break it down to the lemonade stand example,
Mm.
where, hey, look, if you want to create a lemonade stand, what's the first thing you do? And the answer would probably be go buy lemons, and then we'd buy some sugar, we'd buy some water, buy a jug, buy some glasses, and we just essentially make a list of how much we're spending on all of these things.
Mm.
Uh, and that would, let's say, add up to $1 per drink. And now if I want to make uh, the same amount of money back, because at the end of the day, your lemonade stand is a business and you want to make more money out of it, uh, we sell that glass of lemonade for 1.2 or 1.5 or 2 or $6, depending on how hot it is outside. Um, and then that if we put all of this down on paper or a cool computer software, that's essentially a financial model.
It's been very insightful, and I hope to share this soon. Looking forward to it. Thank you.
Thank you for having me, Karishma. It's been really fun chatting with you.